please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's invite our market master, Bharat Iyer, head of Equity Research in India for JP Morgan, joins us in our studios. Good morning, Bharat. Thank you very much for joining us. Did not intend to give you a dreary welcome at all. But then the index is holding up, you know. 10,600 is not a great distance from the 10,800 that was the near-term high. What's the sense you're getting? Is this market likely to see some severe heart attacks because of what's happening in China or EMs in general?
Well, Lata, we started this year expecting a low return, high volatility year. The Nifty was at 10,000 and we had a fair value target of 11,100 to 11,300. I think we're at the halfway mark, and what we've seen is, you know, the index has given returns of 6–7%. So not a bad outcome after last year. We've seen a fair bit of volatility. I think this trend will continue through the year. We do believe that, you know, we are not in a bear market, and we will hit 11,300 during the course of this year. But that said, I mean, you will see a lot of volatility both for geopolitical reasons as well as because of local political calendar.
Bharat, good morning. We may not be in a bear market for the large cap indices, but in the broader market,
I think yes, Anuj, you're right. I mean, the mid caps, I think, are very vulnerable, and rightly so, because, you know, there were meaningful pockets of excess valuation there. Never mind the fundamentals of the companies involved. So with the cost of money becoming more expensive, both locally and globally, you know, valuations do tend to be more vulnerable on this pack.
No, so my question was that we had a big cost of capital rally in 2017. Is that over now, or you think this is a correction that should be bought into even for mid cap and small caps?
See, I think cost of capital is something that will remain under pressure for the next 2 or 3 years. Because, you know, I think the consensus estimates are for, you know, the RBI to hike a couple of times more over the course of the next 12 months. Globally, I think if I look at our own house view, we're looking at 4 rate hikes this year and another 4 rate hikes next year. So the cost of money pressure will remain, and which is the reason, you know, earnings growth will have to do all the heavy lifting for markets, and that means you have to be cautious on multiples.
So what do you think the main reason for this market fall is? Is it largely global? And if yes, do you think it would be a great buying opportunity? Because that's been the case in the past.
See, Sonia, the way I look at it is, you know, you have to keep your expectations of returns modest over the next 2 years. I think, you know, a 10–12% return every year would be very good, because markets will have to fight the headwind of rising cost of capital, both locally and globally. And that is something we'll have to come to terms with. So as I mentioned, the heavy lifting will have to be done by earnings growth. So the focus clearly will be on sectors and stocks that can grow earnings rather than where multiples have been inflated.
Okay.
So as I said, you know, not calling for a bear market, but we have to appreciate that we are in a very mature bull market at this stage, which means return expectations will moderate.
Okay. Oh, now let's speak a little about sectors. When you speak of cost of capital damaging markets, one of them that would be free from that would be perhaps the IT stocks, I mean, not borrowers at all. And of course, now we are talking about rupee at 69. So is that a safe place to be?
It's a reasonably safe place. I mean, it is in a sector which has
You've already given 40% this year.
Yes, but it's a sector which, Alata, will continue to have appeal from a tactical point of view, because, you know, you are facing a very choppy environment, and this is a sector where, you know, you do have the tailwind of INR depreciation. That said, I guess, you know, from a very fundamental point of view, you're not seeing meaningful earnings upgrades in this sector for operating reasons. You know, which is a cause for concern. But that said, yes, INR depreciation is a tailwind, and as I said, in this environment, you know, earnings upgrades matter. It does not really matter where they come from. So for tactical reasons, the sector has appeal.
Okay. You know, mid caps are falling like 9 pins, especially the ones which have given you great returns in the past. So, you know, we were just talking about names like Edelweiss Financial, Havels, Ashok Leyland, etc., M&M Financial. Would you buy these good quality companies now?
I would buy the better quality names in this pack, where I know that earnings are going to compound over the next 2–3 years by, say, 15–20% plus. Because, Sonia, the issue with the mid caps was that they were at one point in time trading at a 60% premium to the large caps. That was meaningfully overvalued, and I think we've discussed this in the past on your show as well, that, you know, the mid caps were looking very vulnerable, both late last year and in March when we were discussing this issue. So I guess, you know, it's par for the course that they correct. I guess what one needs to be is a bit discerning right now. There are companies which will compound earnings at 15–20% plus, and for them this correction is a buying opportunity, because, you know, particularly those linked to the consumption theme, the urban consumption theme, I think, you know, there's a structural opportunity there. So we would be buyers there in a correction, but for a significant part of the mix where, you don't have the earnings compounding story and where, valuations were re-rated for other reasons, I guess, there's not going to be an easy comeback.
Okay. Before I came to the mid-caps, I wanted to discuss what we normally discuss along with IT, pharma. They were in a perfect storm up until last year. Yeah. Drug issues, Trump pressure on prices, rupee being strong. Some of it has receded or maybe already priced in. Is it a sunrise sector now?
No, Lata, I don't think it's a sunrise sector at this stage.
That's a strong word, but is it a buy?
See, I think it's, we are looking at the sector bottom up because, the way we see it, even now, we don't see the kind of macro tailwinds we need to get comfortable with the sector at large. Because let's face it, I mean, generic pricing, I think the pressure continues for a few more years and meaningful pressure at that, 8 to 10%. So there's no easy getting away from that. And I think, that is a theme that will recur. So what companies will have to do is they need to find an offset to overcome this pressure. And yes, I mean, to be fair, companies have very good balance sheets. They're all investing particularly in the specialty part. And those who are ahead of the curve on the specialty part can offset this pressure. So I guess from our point of view, this is a sector where you look for opportunities bottom up, but we are not getting carried away top down on the space.
Okay. How big is politics this year in terms of risk, and has the market priced it in? History has told us that it doesn't matter beyond 2 or 3 days and the market moves on, but that's risk, right?
No, Anuj, you're absolutely right. I mean, even I'm in agreement with you. I think, politics leads to a lot of volatility, but I don't think, it really determines the market trend unless, policies are going to be overturned completely, which we haven't honestly seen in a long time. But yes, will it lead to a lot of volatility? It does. In terms of pricing in political risk, I guess it's too early. I mean, we're 12 months away from the next election. So I think, it'll be better to hold one's horses, and a lot can happen in Indian politics, as we all know, in 12 months. That said, I mean, I don't think the market at the headline level is pricing in political risk. But if you see the internals, I think there is a fair degree of that being done. I mean, you look at the, you look at a stock, you look at, the oil marketing companies, for example. I mean, here, to be fair, I mean, price increases are being put in very, very regularly. But that said, I mean, the stocks are still getting pummeled. So, it's a clear case of political risk getting priced in.
Okay. No, I'm not able to buy this political risk not important argument much. I mean, let us remember, where was the index at, say, September 2013, when it became very clear that Narendra Modi is going to be PM. I know that there were state elections. Then again, December 4th, 2013, when the index was around 6,000 or less. And, we have meaningfully risen from there. It's a 50% gain. Even if the index goes to a bottom of 4 digits, we would still be 50% up. This is an India risk that got reduced because you have a stable polity and a prime minister with a very good majority. If that India risk premium starts to rise because you're seeing political instability, surely some of this gain will be taken away.
Some of it gets taken away.
The India risk becomes 5% instead of 3%.
Some of it gets taken away, Lata, but to put the issue in perspective, you mentioned September 2013. September 2013, virtually every market in the world was getting pummeled because of that taper
December 2013. December 4th, I remember very well when the state elections came in.
If you see, Lata, from say, the middle of 2014 or even early 2014 to current, I don't think India has meaningfully outperformed global markets. Yeah. I mean, our performance has largely been in line with the rest of the global pack. But, I agree with you. It's not to underscore the importance of, a stable government and, a government that acts, etc. But I guess, you'll really need to wait for that because, as I said, 12 months is a long time. How many times have we all got election results wrong?
Yeah.
So, I mean, we'll have to wait for it. And again, right now, I don't think anyone is calling for, a very fractured mandate. So let's give it some time.
So in your interaction with your clients, have you noticed, the FII clients that is, have you noticed that the appeal for India has reduced with respect to investments compared to what it was 6 months ago?
See, I think, investors by and large, emerging market investors by and large are running a neutral to marginally overweight position on India. Okay. And I think most of them are very comfortable with that position at this point in time. Because, they all understand the structural appeal of India in terms of, the demographics, the ability to absorb capital, etc. But at the same time, they understand the cyclical headwinds being faced because of, higher oil prices and higher cost of capital. So, they have to, offset the structural with the cyclical. And so on a near-term basis, that is a 12 to 18-month basis, I guess everyone is comfortable with the positions they're running.
The reason I ask you is because I was going through a note from your team where they said that India could see an outflow of close to $500 million because of China-Asia inclusion. I mean, we've already seen a big outflow, right? You expect it to get worse?
Sonia, these notes, I think, have to be put in context. These are basically related to what happens to passive money. I mean, the index benchmark money, the ETF money, which comes in and goes out depending on your weight in the global index. And so this is, purely looking at, that metric. But X that, as I said, most of them are very comfortable running a neutral to a marginal overweight. They're obviously looking for a better entry opportunity and for, the risk to recede. But I don't see many of them, wanting to go underweight as such.
Okay. I'm reading your financials list. There are the predictables, HDFC Bank, Kotak Bank, and there are the slightly, non-consensus ICICI and SBI. We've seen seminal falls in banking stocks in the past. At least June has been very cruel to them. And now it looks like an AMC or whatever to take away some of the bad assets is not going to come that easily. You're still positive with these two?
See, let me give a more broad-based answer to that question. On financials, we've been advocating a kind of a barbell strategy because what we liked and we continue to like the retail private sector banks because, one, they benefit from the demographic dividend and also they benefit from, continuing to take market share from the rest of the segment. But we're advocating selective exposure to, the corporate banks as well. Because, one, we must appreciate that as far as these banks are concerned, it's not just about the corporate piece. I mean, they have a very vibrant presence across a broad range of financial services, be it insurance, be it mutual funds, be it investment banking, all of which, I mean, they're doing very well and they're market leaders in. Secondly, I guess, they have a very strong retail franchise. If you look at the liability franchise, it's very, very strong. There was just one piece which has been misfiring, which is the corporate book. And there, I guess, Lata, so much has been done. I think in the next 4 to 6 quarters, I think we are going to see resolution. And, if you're a large investor, you want to start positioning for it now.
Okay. The other day we were talking to Sanjay Mukim of Bank of America Merrill Lynch, and he mentioned that in his road trip, he found that the evidence is that government spending has picked up a lot as far as roads, infrastructure, railways concerned. And you echo that same theme in your note. How do you play this from a market standpoint?
See, Sonia, I think, to be fair to the government, I mean, they've, not spread themselves thin on the infra space. I mean, they're just 4 or 5 areas they've really focused on: railways, highways, power transmission, and renewables, and affordable housing. And as you pointed out, I mean, the data in all these areas is doing very well because a lot of hard work has gone in terms of creating a portfolio of bankable projects. And you're seeing the evidence of that. You look at cement sales, decisive double-digit growth for what, 5-6 months now. Look at commercial vehicles and tractors, a sector that you track very well, autos. I mean, you've seen great numbers coming there. And, this seems to be something that can sustain for some time. So, I mean, we've been buyers of cement, of commercial vehicles, of tractors, of select contractors for some time, and we think that this is really the best way to play the government spending in infrastructure.
Okay, by the way, the market's making a bit of a comeback. The bank Nifty definitely is, and HDFC Bank, Kotak Mahindra Bank, the two stocks which really have been the strongest, they are batting for the bulls. Together, these two account for over 40% of the bank Nifty, so obviously that makes a difference, and that yesterday's low is being respected, at least on the index level, though the problem, of course, is in the broader market. From retail investors' point of view, how to approach this market now, especially the new money which saw 2017 and thought that this is how money is going to be made in markets.
Well, Anuj, 2017, it doesn't get repeated very often. I guess, every once in 5 or 6 years, you'll have such a low volatility, high return year. And, I don't think that's going to get repeated in a hurry. I think, to be fair, the retail investors, played this market very well. Yes. I mean, you look at the money that's come into local mutual funds, particularly through the SIP route, and the way it's been so sticky, I think they're doing the right thing. I mean, increasingly now, the younger lot is recognizing that, look, equity as an asset class requires a longer runway. And they can afford to do it. I mean, at that age, I mean, you have more risk-taking capability. You can wait for a longer time frame on your investments. And I think they're doing the right thing by taking the SIP route, and may that continue.
Let's hope the fund managers also take the right route and don't get carried away by the mid-cap rally. Bharat Iyer, it's always a pleasure having you with us. Thank you very much, and visit us again.
Thank you.